Hello and welcome to a new concept, a concept of how to get your asset allocation right. And that is what we would be debating, discussing, ideating, and perhaps in this case, even educating our viewers. What is pro investing all about? And what is the unique edge which Birla Sun Life AMC will be providing to your portfolio? They say that 80% of the wealth is done by the right asset allocation. But how should one go about choosing the right asset allocation? All of us are spoiled with the choice of plenty, but it is important to stay focused and it is important to stick to your asset allocation. Let's take that conversation forward with Mahesh Patil. Mahesh, so nice to have you back in ET now and meet you after COVID in person. Vishal, I'm meeting you for the first time in person, so really nice talking to you. And Anil, I must say that I've seen the performance of some of your schemes. You've mastered the art of beating the index, so congratulations on that. Lovely to meet you. Mahesh, I guess my introduction was the question in itself. That 80% of the wealth is done with the right asset allocation. But that's like a mission statement. We all should exercise and eat less and we will not gain weight. Right? That's the mission statement all of us want to go. Stick to the right asset allocation. Easier said than done. Yeah. How does one go about doing it?
Yeah, so I think asset allocation, we have seen that time and again, right? If you stick to that, because typically investors during bullish markets, want to go overboard on equity, and when markets are bearish, you want to take away money out from equity, right? But actually, inverse is the true, right? I mean, you should be putting more money into the market when the markets are down, right? When they are more attractive, and try to really rebalance the portfolio, when the gains are much larger. So I think that is the key essence of asset allocation. Now, within asset allocation, it is across asset class, and within equity itself, because equity, we know over a longer term, I mean, if you hold equity, it will obviously give good returns, right? So it's a no-brainer in that sense. But within equity also, there's a lot of different products, which are there, right? We have large cap fund, we have got the flexi cap funds, the mid cap, small cap, thematics, plethora of the balanced advantage funds. So within that, again, how to really allocate, because that's a question which investors have. That is what is also equally important, right? Besides investing across asset class. So while it is cliched, but I think I've seen that if you stick to the asset allocation, then while the returns might still be similar, but what it does, it reduces the volatility. So on a risk-adjusted basis, I think for an investor, and that's what investors look at, right? Trying to reduce the volatility. I think it works wonderfully well.
So it's very simple that what you're addressing with pro investing is that when people ask you, "Kaun sa fund lene ka?"
Right.
That's this investing approach is essentially making it simple.
Yes.
How will it work?
So the way it will work is that, we always have a core part of your portfolio, right? Which is, you tell any investor, this is your core portfolio, which will really, as an entry-level investor, you should be investing in. And then you had a satellite to your portfolio, right? Once you have had enough of core part in your portfolio, then you start getting more risk in your portfolio. So pro investing is all about trying to build that core portfolio. So we think that the three components of that is, one is a large cap fund, which is always first kind of entry level person investing into equities. We look at a large cap fund, which is essentially the blue chip companies which have emerged, which are much more stable. And then there is the flexi cap category, which is there, which is investing across market capitalization, agnostic to market cap. And the fund manager really decides, what kind of a market cap allocation should be. And then to add balance to the whole is the balanced advantage category, where the asset allocation moves in tandem with the market valuation. So I think these three are the core part of one's portfolio, and pro investing is all about getting the mix right about these three core products and giving one solution to the investors, and making it very simple.
Vishal, why is there a balanced touch to this kind of an investing? Because when you are investing in a diversified manner, do you really need a balanced advantage approach?
Right. So what we have found is that a lot of investors ask us how to time the market. So the balanced advantage category actually takes care of that through disciplined asset allocation, looking at the PE multiple levels of the market. Let's say if the PE multiples are really expensive, then the equity allocation goes down. And when the PE multiples go down, let's say during the COVID times, when the markets fell 50, 60%, that point of time, our fund as well as the industry funds equity allocation moved up from 30% levels for us to all the way to 80% during those 7 months. So I think that really helps the investor to get the asset allocation right through balanced advantage funds, and investor doesn't have to worry about the levels at which he is coming into the markets. If the levels are high, equity allocation will be low and vice versa.
Anil, does this kind of an approach work very well in a bull market, or this works very well in a volatile market?
No, I think it works, if you ask me, much better in a volatile market. But even in a bull market, this approach would work well because, as Mahesh said, it's all about risk measured returns that we speak about, right? I mean, so when particularly let's assume, FlexiCap being a part of the Pro, if you look at from an industry perspective, you would see approximately about 35 to 38% of the assets under management within the FlexiCap category would be in small and mid caps. And, so the investor gets a flavor of the small mid cap in a reasonable manner. It gets the alpha or the upside that the investor really wants to get in a mid cap or a small cap, which, is growing at a higher base because of, the lower base, it's growing at a higher percentage growth rates, and which will hopefully some of them will eventually become large cap. So you're early on in some of these names when you come into a flexi cap and you're getting reasonable amount of percentage holdings in that. So if you ask me, it's a perfect fit in both kinds of markets. And our time testing that we've done across the various long periods of time that some of these funds are there. For instance, the flexi cap category has been around for about 24-25 years. Frontline and large cap category has been around for similar number of years, etc. And so has balance advantage been around. So any back testing that you've done, you've seen that the returns genuinely across time frames have been superior to the benchmarks, and it takes away the good part is it takes away the decision making on a regular basis that an investor wants to do, trying to time the market, trying to say, boss, should I go into mid cap, should I go into small cap, what about, I just think it just makes life easier from an investor perspective.
So Anil, let me just break it down by using the food analogy. Right now I look at the entire investment industry is more like a food court where you have to choose and you have variety to choose from.
Absolutely.
While the common goal is very simple, that every counter and vendor will give you a satisfying meal. So that's the food court kind of environment you are in. What this product is that you go and sit on the table and I will serve you a thali.
I will serve you a thali, okay, absolutely right, which should be, A, good in taste, 2, will suffice as far as your hunger is concerned, and 3, you will make sure that you're not having any health issues.
And the thali will have a salad, main course.
Will have a salad, a main course,
and a dessert.
And a dessert.
Okay, so it's a complete meal you're giving me rather than giving me option to choose.
It's a complete core meal that you can get, as we call it, as a part of a core portfolio. You're getting a complete meal. Okay, you want to add on to this with some snacking items, then obviously, you will need to go to your satellite portfolio, some thematic funds and so on and so forth. But as far as the proper meal is concerned, here is one.
Mahesh, who should invest in this scheme? Somebody who's conservative with his investment, because this also will be an option to diversify. When you diversify, I may be compromising on the returns, but I'm also considered to be conservative. Who should invest in this kind of a scheme?
So ideally, I would say a first-time investor who's looking to invest into equities and looking to build a core part of his portfolio. I think it's ideally suited for those investors. And once he has done that and tasted over a period of time, then and once he's conversant with the other products and the risk of what are associated with investing in the market, then he can diversify into other satellite products. So it's for the first-time investor, for any investor, okay, with a slightly lower risk profile, I would say, it is ideally suited. So it's slightly for a conservative investor, but again, even for moderately risk-taking investor, also this product I think should give return, because what we have seen is that in this core portfolio, the combination of these products, the returns there are similar to what you will get over the market returns, slightly above that. And the volatility is much, much lower. So on a risk-adjusted basis, the risk return is probably comparable, which could suit for any conservative or moderate investor.
Vishal, there's a debt component to this.
Right.
What would be the debt component of the aggregate portfolio? And I'm asking you again, very basic question. We're trying to connect with viewers here. If I choose, let's say, this proactive scheme, will the debt component of my portfolio be taken care of because of the diversification?
Right. So the beauty of a balanced advantage category is that the asset allocation is dynamic. What it means is that, let's say, when the market levels are low, at that point of time, the equity exposure in this particular fund will be very high, and the debt portion will be very low. And when the markets move up, let's say, and go into euphoria zone, that point of time you will see the net equity exposure to fall to, let's say, 20-30% levels, which means that the balance 70-80% of the portfolio will be either debt or arbitrage. Now, when I say arbitrage, the reason is that at all points of time, the gross equity exposure of balanced advantage fund would be 65% or above that. What it means is that it will help the investor to get equity taxation for the entire balanced advantage category. So whatever returns are being made here will be taxed at equity rate of taxation. Even if the net equity exposure is 30%, there will be an arbitrage book of 40-45% to take the gross equity to 75%, 65% plus, and the balance would be debt. So that's how the asset allocation happens in balanced advantage between equity, arbitrage, and debt.
No, but at a net level, since there is a debt component also in it, what would be the tax on the total profit once you book your gains? What would be the tax?
So let me answer that. So overall, if you look at on the balanced advantage fund, it's always 65% gross equity exposure. So the equity taxation will apply over there. And on an average, on the balanced advantage fund, your debt component over a market cycle would be somewhere around 50% or so in that region. So normally in a portfolio, if you have 25% allocation to a balanced advantage fund, your debt component will be around 12% or so. Okay. So it won't be very high, it will be varying between 10 to 15% in that range. Essentially, it's a equity, long only equity kind of a solution, okay, which we are trying to give to investors to the pro portfolio.
With a layer of debt, which actually is not the large, it is more like a safety net which you're trying to build in a volatile market.
Right. Yeah.
Okay.
Yes.
Mahesh, so by default, if somebody is investing in the pro investing scheme, what is the default breakup between the three schemes?
The default breakup, see again, we normally have an asset allocation, okay, with an equity where we say 25% should be into kind of a large cap fund, around 35-40 into a multi-cap fund. So with the pro investing, I think the default is 50% into flexi cap,
okay,
25% into large cap, and 25% into the balance advantage fund. That is what normally we recommend. But investors can choose depending on the risk profile and their appetite and vary that. But I think this is the ideal combination which we have seen, which gives overall longer term returns which are superior on a risk adjusted basis.
Over the years, when you look at back testing of this scheme, individually if you look at three schemes versus this combined entity, has this scheme managed to beat the benchmark?
Yeah, so over a long period of time, what we've seen, the combination of this results has been able to beat the benchmark. But I think it's not about the returns alone, right? It's also, as I mentioned earlier, what is the overall volatility which is there, right? Because investors come into the market at various points in time. Yeah. And somebody coming in, say, at the peak of the market, his experience will be different vis-a-vis somebody coming at the lower end of the market. So the volatility is what I think we tend to address in this. And we've seen the volatility measured by standard deviation or whatever is much lower than the benchmark index.
Fair point.
Yeah, just to add here on the point of volatility, if you look at the balanced advantage category, for example, the fund that I am looking at, last 7 years, if one looks at it, the net equity exposure is around 51%.
Even in January?
Net equity over the last 7 years period.
Okay, that's average.
Yeah.
Okay.
But if you look at the volatility of the, and returns have been 91% of Nifty 50 returns, and the volatility has been 63% of Nifty. So much lower volatility and returns is in line with the benchmark.
Fantastic. So Anil, my next question before we wrap is, we all are measured And unfortunately, in financial world, mutual funds are measured, and the measuring is done against benchmark.
Sure.
What becomes the benchmark for this kind of a scheme? Because all the three individual schemes will have different benchmarks. So how do I know this scheme is working for me or not?
Right. No, so basically, each of us have a particular benchmark. Okay. So depending on the percentage that the investor chooses to, that amount of weight, that particular benchmark will be a part of the pro. So as Mahesh said, by default, if it is 50% in FlexiCap and 25-25 in that, the benchmark weight automatically for a FlexiCap benchmark weight will be 50% of that weight. The large cap weight will automatically be 25% of that benchmark, and the same for balance advantage. And you'll have a proper benchmark for that particular to see.
If I'm looking at, let's say, starting a SIP in pro investing,
sure.
And depending on what I follow, Mahesh, in terms of my asset allocation, that benchmark will be defined to an unit holder.
So we have a default, as you mentioned, right? So it's a composite benchmark. So we have a composite benchmark, okay, which will be there. Yes, there will be a composite benchmark which you
I just explained to you the methodology of the composition. That's it. It is a composite benchmark.
Mahesh, they say that past performance is no guarantee of future returns. Since you mentioned that past performance here, they've been benchmark beating, what we should expect for future returns from this kind of a scheme?
So I think it's all about how the individual schemes do, right? Fund managers we've seen in the last few years, beating the benchmark has been a challenge for active fund managers, and especially in the last 3 to 4 years. But I think if the individual funds, underlying funds which are there, are able to beat the benchmark, whether it's in the large cap category or the flexi cap or the balance advantage category, then overall aggregate basis should do much better, right? Because automatic rebalancing would enhance that. And I think going forward, I think I'm still, while there is a lot of debate about active fund managers able to beat the benchmark, I think we had in a period 18, 19, 20 where the markets were very narrow, few stocks did very well. But I think as the markets are getting more broad-based, we are seeing domestic economy now starting to do well. So a lot of sectors are now doing, it's not just like 2-3 sectors, which was the case earlier. And India is an economy where we have seen a lot of new emerging companies come in before they really become part of the index. So I would guess that our individual funds, okay, which we are managing, are able to beat the benchmark. Then definitely the overall pro combination should be able to beat its composite benchmark.
Mahesh, we have a flavor of the schemes you manage: long banking, long cyclicals, long engineering. Is that your market overweight positioning for next couple of years? That you're bullish on domestic cyclicals, bullish on inward-looking sectors?
Yeah, so I think our view has been at the beginning of this calendar year, we said that India economy is set for kind of a turnaround, right? And a lot of things are falling in place. A lot of sectors which were not doing well earlier are now looking good. And especially in this time when we are seeing globally, okay, there are concerns whether it's in US, Europe, China, global growth slowing down. I think India still relatively looks much better. So definitely, I think last calendar, it was more about global cyclicals, right, which did well. But as you move into this calendar year and also going forward, I think domestic focused sectors, whether it is in the banking and financials, consumer discretionary, whether real estate, industrials, cement, I think those are sectors which really look promising to us going forward.
Vishal, before we wrap, tell us a bit about your positioning. The central bankers are trying too hard to fight inflation, but I don't think the war is won yet.
Right.
Markets are no longer oversold, which means equity markets are looking okay. So the fund which you manage, which is a combination of debt and equity, how is the positioning?
So right now, Nikunj, we are at 52% net equity in the markets. And it's a balanced mix between equity and non-equity, which is arbitrage and debt. If I look at the PE multiple levels, we are possibly 10% higher than the average for the last 10 years. So valuations are not cheap, and you have this issue of Fed rate hike, and we saw Fed was really hawkish in the Jackson Hole. So clearly one has to look at it from the macro headwinds that one may anticipate. So from that perspective, we believe the risk reward is balanced, and we are therefore at 52% net equity. If the markets were to correct, our equity exposures will go up.
And let's wrap it up with your current positioning. You have the flexibility to cut across scheme. And when the economy historically is at an upturn, small caps and mid caps, they do much better than large and established players. What's your market view? What's your positioning?
So we are currently about 65% in large caps and about 20%, 21% in mid caps, and the rest in small caps. I think from a market view perspective, it'll be a very choppy and a volatile year, as we've already seen. We had a peak in early April. We then saw markets coming off a reasonably large, decent percentage, and somewhere in July we actually bottomed to about 15,300 odd Nifty, and then again we had a very, very rapid move, almost a stone's throw away from from the previous peak, and the last week's again been very. So I think brace yourself for a decent amount of volatility given the geopolitical situations, given more important the fight against inflation across the globe that central bankers are doing, but net India, I think, will have a tremendously positive next 3 to 5 years from an economy perspective, from growth, and hence, equities in India should do exceedingly well.
So good to hear that. And Mahesh, so nice to meet you after almost 2.5 years. And Vishal and Anil, it was lovely to meet both of you. Good luck for this scheme. I would say this kind of a scheme is more like need of the hour. When long-term investing can be made slightly less complicated, one more less thing to worry about. Give your scheme, you give your money to one scheme, and then everything has been taken care of. So really appreciate your time. Thank you very much for joining us.
Thank you.
Thank you.